All right, in this video, we are going to go into a whole life insurance policy and attempt to better understand the cash value in simple terms. I'm not going to go into as much detail as I usually do. Let's get into it. So when it comes to the cash value on a life insurance policy, what I'll mention is 99% of the people we work with, their main point of interest is the cash value. Right? When we hear the words whole life insurance, or I should say insurance in general, right? I say insurance, what comes to mind? Premium. I pay a premium every year, every month, and when I die, if it's a life insurance policy, money's paid out to my beneficiaries. Then we hear stuff about whole life insurance and the cash value component that makes it sound really good, but then there's not a whole lot of transparency in respect to the information out there. You know, when it comes to the information around whole life insurance, typically there are two ends, and they are polar opposites. The first side is whole life insurance is the worst area to put your money. Don't put anything there. It's junk. Buy term and invest the rest. You'll always have more money. And then the other side is whole life insurance is the best area to position money. When you look at the ultra wealthy, big banks, corporations, they put a boatload of money into cash value life insurance. And a lot of individuals we work with do the same thing. So why are there two sides here? Polar opposites? Well, really has to do with this guy. For the whole life insurance policy, the design is key. We're not going to spend time going through how to design a policy in this video since I do that way too much. If you have not seen our video on how to maximize the cash value in a life insurance policy, I definitely recommend viewing that, where we walk through how to design a policy for maximum cash value. What I will touch on is this. When I see a whole life insurance policy, we mentioned there's a lot of information out there that's very good, has a lot of positive things to say about whole life insurance, and then information that has not so good things to say about whole life insurance. Here's how I look at it. Now, our company sells whole life insurance. We design it for maximum cash value, and our mission is to provide transparency and convenience to everyone we work with. Those are professionals in the industry and also consumers looking to purchase policies. But with that said, how do we design a policy, or why do we see differences out there before we design a policy? Why do we see those two opposite ends of the spectrum? Really bad, really good. Because here's an example where we have the exact same company, exact same 40-year-old male, exact same cash flow. It's a whole life insurance policy in both examples. One example looks very bad. So when we read or see the stuff that says stay away from whole life insurance, it's the worst area to position money, $20,000 a year going in. Look at this, 5 years in, I've paid in 100 grand and I have $48,000 in cash value. Zero right off the bat. By year 14, when you start to see the highlighting in yellow piece, I'm finally positive relative to what I've paid in. So when we hear or read or see videos that state whole life insurance is the worst area to position money, takes forever to get your money back, typically it's referring to a traditional whole life insurance policy, the bad. But then we hear of these corporations and wealthy individuals just positioning tons of cash into whole life insurance policies. They're not doing this. Same out of pocket, cash value right off the bat, and a death benefit. What's highlighted in yellow represents my break-even point, when I have more money in cash value relative to what I've paid in. This has more money short-term and also long-term. Same company, same out of pocket for the policyholder, drastically different results. Good and the bad. See, if I have a laser focus on cash value. This guy, I do have a higher death benefit right off the bat. So it's good to consider that as well, especially if I'm interested or have a need for death benefit right off the bat. So let's break down the cash value a little bit and just highlight a couple bullet points here. So we've got safe, liquid, tax-free, and always compounding. Right? So these are some core benefits to any whole life insurance policy. Around the safety. So A life insurance policy is a safe area to position money. A lot of times we'll work with individuals that have a lump sum of money just sitting in cash, right, in their bank account. Maybe it's in bonds and another fixed asset, and they look at this and say, hey, here's an area I can position money regardless of my situation and how much I have, build up my cash value in a policy, and leave a legacy through a death benefit. Sounds like a great deal, and it is, looking at the guarantees and non-guarantees. So on the safety, what I mean when I say that is there's no risk, meaning if the market tanks or the economy tanks, I will not see my policy all of a sudden lose value. Not going to happen like what I would see in the market. Often, I will see a guaranteed rate of 4%. A company would pay a surplus in addition to that. Then I would see a total dividend rate. Dividends for 2020 with the top companies out there range from about 5 to 6%. A little bit over for some companies, 6%. Now, when I mention that in 2020, we are at the end of August here. It's hard to get a bank account for 0.4 or 0.5% for a lot of people. So how on earth are insurance companies paying these type of rates on cash value life insurance products? Here's the thing. These are gross rates. So it is a safe place to position money. But again, to be as transparent as possible, here's my poor penmanship. That's better. If I have a dividend of 5%, 6%, whatever it might be, that is a gross rate that is credited after the insurance company's expenses and mortality tables. What I am most interested in, what's my net performance? The insurance company will refer to it as IRR, internal rate of return. If I have a 6% dividend, I'm so many years into the policy, I might see it produce, call it 4%. Let's just use simple terms. I might do between 3 and 5 or 3 to 6% as far as a net internal rate of return on a life insurance policy over time. Meaning after all the insurance expenses, everything are said and done, I can peg it there. To go a bit more conservative, let's call it 3 to 5. Historically, they've done stronger, but we are in an extremely low interest rate environment right now. So, safe. Great. Let's give ourselves some more space. Perfect. Liquid. Huge advantage here, right? I want to put my money somewhere where I will actually earn something on it, but I don't want to have to tie it up. Like I don't want to lock it up like I would in a 401k or some other type of account. With a whole life insurance policy, a cash value life insurance policy, I do have access to my money. Typically, I can access it fastest through a policy loan. If I request a loan, typically, depending if I'm going check or direct deposit, call it 3 to 7 business days. Now, as a side note, and we've got more videos on all of these topics on our YouTube channel and website. Contractually, you'll see, I've seen it with every insurance company when I've read through the contract language and searched for this piece, is companies do reserve the right to hold loans, loan requests for up to 6 months. Good to be aware of that. I've never seen this happen or heard of it happening even through the Great Depression. Didn't happen in 2008. However, contractually, they do reserve that right. So it's good to be aware of that. But for the most part, extremely liquid. Tax-free. Now here, I am going to put in red the word if. If we set the policy up properly, and if we do not trigger a taxable event, we can use it tax-free. Why I add that word in there is what is heavily marketed around cash value life insurance is the fact that it can be used tax-free. And frankly, that draws in a lot of interest. It piqued my interest as well. The thing is, it is possible for a taxable event to occur on a life insurance policy. Some things that can result in a taxable event would be if I trigger what is called a MEC, Modified Endowment Contract. If a policy lapses or I cash it out with a gain on it. If a policy lapses with an outstanding loan and there was a gain on it, and we've got more videos that really go into more detail there, because that can be not a complicated topic, but can take a little bit of time just to understand. And we always like to be thorough, so I'm not going to go into all of the details here. My point to this, generally speaking, is huge benefit to cash value life insurance. I can use it tax-free. Important to be aware of, however, what could potentially strip me of the tax benefits. And then always compounding. So a unique feature to a whole life insurance policy is that once a dollar passes through a policy, regardless if I let that dollar sit there and earn, call it 5%, or if I decide to access it and borrow against it, I continue to receive 5% or whatever the earnings rate is on my entire cash value. To illustrate, if I have a total cash value of, let's say, $100,000, whether I started out with a lump sum payment or I gradually built it up. I have $100,000. We'll assume that the dividend rate is 5%, and I loan out half of it. Now, if you had $100,000 in a bank account and you elected to pull out half of it, $50,000, how much would you still earn in that 5% bank account? The half that's remaining. Life insurance policy does not function in that way. Now, when I borrow, there is a cost to the loan. Typically, you'll see that between 5 and 6%, depending on the insurance carrier. However, I had $100,000. I loaned out $50,000. The insurance company will continue to pay me that 5% dividend on the entire $100,000 as if I never touched it in the first place. How they do that? 2 reasons. One, there's a loan interest expense on the amount I pull. And then second, anytime I take a loan out, my death benefit is collateralized dollar for dollar by the amount I access. So in this example, if I had a total life insurance benefit initially of $1 million and I loaned out $50,000, the net amount that would be paid out if I died with that loan outstanding would be $950,000. Now, if I ever repay it, I see everything fully restored to exactly what it would have been as if I never touched it in the first place. Always compounding, no lost opportunity cost. We've got a lot more information and videos and flow charts that go into more detail on that as well. But those are some bullet points to the cash value. We've got our chart on how to maximize the cash value as well over time. If you look at it long term, there's your growth. Main point is if I'm really digging into a whole life insurance product and I'm interested in the cash value, the design is key, but it's also good to understand the other pieces like we just touched on. The core benefit, safe, liquid, tax-free, money is always compounding for me. That's great. What companies do I select? Flexibility. These are all additional topics which we've got plenty of content on. You can find that on our website or on our YouTube channel, or you can reach out to us directly. Feel free to call or email our offices anytime. As always, I hope this helps, and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.